Good evening, everybody. I'm Barbara Brown with Redbird Therapy, and we are so glad you are here to join us with David Reine and Kyle Waters, who are going to talk about managing our financial success, which is a big deal, I think, for us as therapists. It's not, for many of us, our strong suits. We may not have learned anything about this at school. We may not have learned anything about this at home. So I am just very happy that we get to host these two wise men and who are also like dear and beloved colleagues of mine. So I'm going to turn it over very quickly to them. Feel free to put your questions into the chat, and we're going to just jump right in.
Perfect. So I'm just going to share my screen here. Perfect. So yeah, everyone can see this. So yeah, thank you everyone for joining me and David today. Thank you, Barbara, for inviting us to speak. Really looking forward to it. Please, as Barbara said, I want this to be as open of a dialogue as possible. So any questions, put it in the chat. Barbara will monitor and we'll kind of answer it along the way because I think we have quite a bit of time tonight. So with that, my name is Kyle Waters. I'm a portfolio manager with BMO Private Wealth. You might know it as Nesbitt Burns as well. But in the private wealth space with BMO. So today, I'm just going to tell you real quick about me, what we do, but more focus on everything's relating back to this journey of life and how wealth kind of relates to that. Okay, and then questions along the way. So a little bit about me. As I said, my name is Kyle Waters. I've been with Bank of Montreal since 2010. Started all in the private wealth space. I started my career in Ottawa, did school there, met my beautiful wife, and then in 2014 moved to Toronto, bigger city, bigger opportunity. It was the thought process. Since then, we have welcomed a little one to our family. She turns 3 in May, with another one on the way at the end of June. So a lot of this, there's different stages of life that, you're starting families and retirement, and a lot of your clients is somewhere in between, right? And that's kind of what I want to talk about today, and in things to think about as well when you're thinking about wealth, because wealth can be very, very stressful, whether you have it or you don't, and we'll go through that. In my spare time, we have my wife has a family cottage up in Muskoka. Love spending time outdoors as much as possible, on the water, surfing, and looking forward to just enjoying the summer this year. So that's a bit about me. With that, what about BMO Private Wealth? So all your clients might be in different stages, and you as well. But at Private Wealth, what we do is we wrap our hands around our clients, provide a white glove service, and take care of all of their financial needs, which really takes the burden of managing wealth off of our clients' shoulders so they can focus on things that are more important to them in their life. Think of us as kind of, as an advisor, a quarterback. So behind me, we have a bigger team of professionals that do trust, banking, tax, philanthropy, succession planning if you're trying to sell businesses or your clients are trying to sell a business, estate planning, tax planning, and most importantly, financial planning. So as a private wealth client, you get all of these services kind of complementary as being a high net worth or affluent family. And this is the type of service that we provide for our clients. So it's just one step up. It's kind of the highest threshold of, you can deal with someone at the bank branch, they sell you mutual funds. We're above that. And what our job is to really create customized investment solutions, sit down with our clients, really understand what are your goals, what are your dreams, what do you want, and how do we accomplish that? And what plan do we put in place to help you accomplish those goals? So that's That's what we do as bread and butter. So I thought this was pretty interesting that, there's two ways to look at life. If you go through life in a linear fashion like this, good for you. Many people don't, right? You start a career, you have a family, you work 40 years, you retire, everything's good. Kind of what the movies tell you life should be. And I heard the term the other day of kind of like the nuclear family, right? From the 1950s and 60s, two kids, two cars, white picket fence, suburbs, have a comfortable life. But in reality, that's that's not how life works anymore, right? Life is more chaotic. You take road bumps, you take twists and turns in every which way that life can bring you. As an example, careers, right? You might start a career once or twice. I was just talking to a client the other day that's in her late 40s, just now retraining to be a psychotherapist. So you can restart your career multiple times. You might retire and then go back to the workforce. You might have multiple partners and divorces, kids from different marriages, boomerang kids, just when you think you're about to retire and you've worked so long to accomplish your goals, and then your kids move back in at 30, which puts a huge wrench in kind of your planning. I've also been talking a lot about the younger generation isn't having kids, right? So the older generation, and I've talked to many clients like this, that they're actually quite emotional about their kids aren't going to have kids. They're not going to be grandparents, sorry, where they thought. And all of these different transitions create a lot of stress, anxiety, and along the way, there's a financial aspect associated with each one of these transitions. Think about boomerang kids. They come back in, well, that's a cost, whether that's staying in a house longer than you need to, that's a financial burden, and so forth. So I won't be able to touch on all of these points, but I wanted to highlight just a few of them that I thought was pretty important, that I'm seeing quite a lot in my job right now with current clients. And again, also things to maybe think about when you're talking to your clients. Oh, how do I go back? I missed the page. So stress, anxiety, and wealth, right? Money is one of the most stressful things anyone can imagine. Whether you have money also causes stress, and whether you don't have money causes stress. Money, we've heard it all the time, money doesn't buy happiness. That couldn't be more true. I was talking to a client the other day that just gave up making $1 million a year paycheck for a $200,000 job because she sat down and realized, what's the point of making this money if I have no time to spend it? I have no time to see my kids. I might lose my marriage, my social circle, and everything. So that's one aspect. And then the other aspect is people working 2, 3 jobs just to, put food on the table and everything in between. So dealing with an advisor to help take these burdens of wealth and put an efficient plan in place is what we do for our clients, so they can focus on things that are more important to them. Which brings us to kind of, thought this was a pretty interesting chart that, life, and there's only a finite amount of time in a given day, right? And when I was thinking about putting this presentation together, is if you're spending an hour or two focusing and stressing about your wealth and your plan and what do your finances, well, then that's an hour or two a day that you're not focusing on your mental and physical health, right? Which makes you a better person. And it's always a balance between the two of them, right? And again, we outsource a lot of things in our life. Like, think about even going to Starbucks and having a barista make you a coffee. Well, you're technically outsourcing that. And you can do the same thing with wealth, right? Have a professional manage that so you can focus on things that you get passion out of, or your clients get passion out of, to just be a better person, right? Because like I said, it can be extremely, extremely stressful. And we all know that mental health, physical health is, it's it's not easy to come by with all the stresses that life puts on our way. And if we can just take that one stress of money management off of your shoulders, then we've done our job correctly. So I kind of want to relate it back to these four topics: practical, emotional, family, and financial. Doesn't matter what culture, heritage, or where you kind of come from, it can all kind of boil down to these kind of four topics. Certain things, certain transitions in life can be very, very exciting. Getting married, having a child, buying a house, and others can be super, super overwhelming, stressful, and anxiety ridden, such as death, divorce, loss of job, and so forth. So as I go through a few examples, like I want to kind of relate it back to this, but I will focus a little bit more on the financial side of things as we go through. So I mentioned this to Barbara this morning as well. One of the biggest things I'm seeing right now is the stress about caring for others. We all know that population's aging. There's baby boomers are getting there, not enough right now, younger generation. At some point, it seems like everyone's going to be a caregiver to someone, whether it's a friend, a family, in one way or the other, whether that's emotionally, physically, or financially. And there's a few ways you can become a caregiver. It can become sudden, like someone got in a car accident or just got diagnosed with cancer. And others, which we see far too often, is kind of a slow burn. Think of like dementia, right? And what that does on the caregiver themselves is it's a huge burden. Maybe not at first, but it becomes a very emotionally drawn out, stressful thing that affects the caregiver's life in so many ways and could also affect them very financially. Think about all the hospital visits, paying 20 bucks at the, hospital for parking. Maybe the person you're caring for doesn't have the finances to care for them proper or care for themselves properly. So you have to kind of, pick up the slack, for better words. And I see this time and time again. And how we work with our clients is, what are strategies? How do we tap into maybe equity in the house to pay for it? What is the end goal with the assets? And how do we make sure that that person you're caring for has a comfortable life? Because like I said, it can be very stressful. So as we relate it to practical, emotional, family, and finances, as I said, from an emotional perspective, again, anxiety, guilt, and so forth. But from family, the more time and the more, again, time is a finite resource, right? So the more time you are providing to that care or providing caregiving services, the less time you're spending with your family, your kids, your siblings, your life. What maybe you have to take time off work, which now maybe you have a loss of income. And how do you pay for all of this, right? So as an example, I have a client, it's been a client for a very, very long time. It's one of those slow burns, right? So he started with one PSW. Now he has 3 full-time care PSWs, two kids that come over once a week, again, taking time away from their families. They have their own families, and 3 24-hour PSWs is very, very expensive. So we came up with strategies about how do we protect your assets to pass on to the next generation, pass on to your grandparent or your grandkids and your great grandkids and so forth. But also still providing care. Because some people just say, sell everything, move into an old age home. But a lot of people, what I find is they don't want that. They feel like that is almost death themselves once they do that. So they try everything they can to stay in their house as much as possible when able. And how do we plan for that? How do we think about financing that? And again, there's strategies that working with an advisor can really, it's like some creative strategies that you think might not be out there to tap into, right? So this is what I'm seeing a lot right now is caring for others. I've been through it myself. My wife's been through it. Someone you know, whether it's yourself or your colleague or friends, this is going to be an ever increasing thing and something to think about and something to talk about your advisor or reach out, obviously, anytime. Another big thing we talk about a lot is retirement and financial planning. Never too early to think about retirement. You could be, 15 years old and start thinking about retirement. The earlier you start, the better you're going to be, right? Everyone has a different thought process of what retirement looked like. Maybe that's freedom 55. Maybe you work forever, right? And everything in between. But through proper financial plan and proper saving strategies, the more planning that goes into it further in advance, the better off you're going to be. Because our job with planning is to provide freedom for you to do what you want and finances not to be the limiting factor. So retirement also comes in two kind of waves, right? Some people can't wait to retire. It's kind of that's what they've been working for and they love it. But for a lot of other people, again, being a major transition in life, they don't know what to do with themselves. They feel guilty, they feel lonely, it's not fulfilling to fill the time. So we work with clients a lot as well as, take that trip or, you have the finances to do it as long as we plan accordingly for it and push clients to live that life that they've worked so hard to accomplish, right? So with that, a few things that come to mind is, yeah, if you're retiring, again, you could be lonely, you could feel guilty that you're leaving your good friend colleagues. The dynamics of that change, obviously, if you're not seeing your coworkers every day, but also now you have to, if your spouse is retired or your partner is retired too, now you're with them 24/7, and that has a lot of different moving pieces as well. And I've seen it gone very well, and I've seen it gone very, very bad, and I'm sure you all have as well. But going back into retirement on the financial aspect is how do you now fund retirement? If you were making X amount of money, now you're not, CPP, OAS, maybe you have a pension. We can model all of this through our plan and software and say, this is how much you can spend in retirement, or this is how much money you need to make as a return target so you don't run out of money. And we do this for all of our clients. Whether there's still 10, 20 years to retirement, 5 years to retirement, in retirement, all the planning we do for our clients, it's a working document. It's not, here's your document, for the next 20 years. Things change. As I said, you have road bumps, curves, maybe you take the wrong turn, and the plan gets updated all the time, right? So how do we make sure that you stay on track? And that's where the plan and software and financial plan really, really works. Because if we do the plan and you based on what you want to accomplish in retirement, you run out of money at 70, well, things need to change, or how do we plan against it? Maybe we have to downsize, right? Maybe we have to sell the house, downsize into a condo. But that also has repercussions, right? Maybe you have to move cities, move away from your grandkids, move away from your family, whatever the case may be. And there's costs to do that, right? And then,
Can I ask a quick question here? Because I think for a lot of us, we're going to be working in sole proprietorship, or we're going to be self-employed for the substantive amount of time. And I wonder what the financial considerations are for that, because you're talking about all these life stressors that any one of us would face and any one of our clients would face.
yeah.
And I think, okay, so what makes a good plan, especially when you have a vulnerability like being self-employed?
Yeah, so it's self-employment. I mean, David will talk about that as well, as corporation or not. But if you're taking all your money self-employment, yeah, it now becomes more of a savings strategy, right? Like how much do you need to live your lifestyle, right? And a lot of times people don't want to go into retirement with debt. Debt isn't always a bad thing, depending on cash flow, but it also depends on interest rates, right? If you're paying 2% on your debt, like it was for many, many years, and you're earning 10% on your investments, well, then it makes sense to invest. But if you're paying where we are now higher on debt versus investments, maybe it makes sense to pay it down. So as we approach retirement, the planning aspect is, what does that asset versus debt or any debt look like going into retirement? Because once that cash flow dries up and you still have that debt, maybe the biggest thing that we're trying to plan for is to eliminate debt in retirement. So if you're just coming out of school and you have student debt, there's, that's fine. You don't necessarily have to aggressively pay that down unless that debt is so big that it prevents you from getting a mortgage, right? It's because when it comes to a bank giving you credit or the amount that you can borrow, it all comes back to your income, but also how much outstanding debt you have. So if you find that you're butting heads about, I can't get the approval that I need for a mortgage, well, maybe now the focus becomes more paying down some of the debt, because everyone has a certain amount of total debt that they can have from a serviceability perspective. So that's where debt versus savings really comes into effect, right? Is what stage in life are you in? Graduating with debt, that's not a bad thing. Going into retirement with $1 million in debt and no income, that's a bad thing, right? So how do we, if you find yourself having a lot of debt in your kind of 40s and 50s, well, maybe the strategy changes a lot about how do we pay that down so the cash flow in retirement isn't completely wiped out with debt payments, basically, right?
Thank
And
you. That's
sorry,
really awesome. Oh, go ahead, David.
sorry, I was just going to jump in because I think how you touched upon this, an important part about it is kind of that planning piece and budgeting. What is your cash flow projections going to be? And I'm going to go into budgeting stuff like that, but also, I guess what you're in retirement, you're looking at RSP contributions and building that up. And I guess, Kyle, you would kind of factor that in and try and see how does that play out as to, if I'm going to need how much money to retire, how much do I need to start saving now? And what does that look like if I save X amount each year?
Yeah.
Is that something you do as well? And
Yeah.
I think this is really helpful to sort of think through like the kind of considerations, right? Stage of life, age and stage of life, the balance of income to debt, right? And what your other responsibilities might be in terms of your family care and, what other kinds of things you're going to be investing in. So even if I were to sit down and think about myself, where am I at as 58, 35 years into my career, I would like to retire, but I probably won't. Maybe not till 75. We'll see. But how do I make that happen? But that's a kind of easy formula to begin to consider pieces that will help even in preparation to coming to see you, for example, to coming to see a financial planner. It's like, oh, I should have those in my mind, right?
Yeah.
What age and stage and debt and income capacity and other financial burdens, assets and responsibilities, right?
Yeah, and when it comes to like RSPs, I get asked a lot of, how much should I put into my RSP? Should I be contributing to RSPs? It depends on your income, right? When you're younger, it makes sense to contribute to RSPs. I think the compound and tax-free growth of an RSP over time makes a lot of sense. But if you're anticipated that you're going to make a lot more money in the future, it makes sense to kind of save some of those RSP contributions up for the future when you're making more money, because the amount you get back on a refund dollar for dollar is going to be higher the more money you make. So if you're straight out of school and let's say your goal is to buy a house, right? Well, you might want to make an RSP contribution to get a tax refund, but you can only ever take out from a first-time home buyer, which I was going to get to at the end, but I'll touch on it now. You can only take out 35,000 through the first-time home buyer. So if you're in your 20s and you're aggressively putting into an RSP thinking you can use that for a house, well, you can only take out 35,000. So maybe you want to direct some of the money into a tax-free savings account as an example, where there's no consequence to withdraw it. And just last year, the government came out with first-time home buyer savings, or home buyer savings account. That is a blend between a TFSA and an RSP. So like a TFSA, there's a maximum you can put in each year. First-time home buyers account is 8,000. You do get a tax credit for it, just like an RSP. But when you withdraw it, there's no consequence, just like a TFSA if it's used for a house. So we've been opening a lot of these for first-time home buyers. So let's say you've tapped out your 35,000 in your RSP. Well, this first-time home buyer also makes sense to start funneling money into it if the goal is to buy a house, because 35,000 from your RSP isn't really gonna, help you when you're buying $1 million house and you need 20% down at 200,000, right? 35,000 isn't gonna move the needle that much on it. So this first-time home buyer thing is pretty good. The one caveat with the first-time home buyer is it's retroactive, but from the day you opened it. So unlike the TFSA, where you can open a brand new TFSA now and you get all the lifetime contributions back to, correct me if I'm wrong, David, 2009, something like that. A first-time home buyer is from the day you opened it. So we had a lot of pressure to open accounts as early as possible so you can compound that $8,000. Because if you open it 5 years from now, you don't get the 5 years of backdated. It's 8,000 from there going forward, unlike a TFSA. So it's a new product. I think it's a good product. But when you're trying to save for a house, put some into the RSP, because then you get a tax refund. You can take that money and then put it back into a TFSA, as an example, or pay down debt, right? So, it depends on your tax bracket, but if you made a $5,000 RSP, and let's say that made you get a $2,000 tax refund, well, then your true contribution is only really $3,000. And then you can take that $2,000 refund and pay down debt, as an example, right? So it's kind of like, it's not free money, it's your money. It's just, you're getting more money invested, saving, growing, while taking the refund to pay down debt or to save in addition to whatever you want to do with it, right? So those are kind of strategies of our RSPs, TFSAs, which all go into financial planning, of what you should do, right? I think you should never invest in a non-registered account until you've at least maximized your TFSA contribution room. So like sometimes you might have, a $10,000 TFSA and then a $10,000 taxable non-registered account. Well, every time we see that, we move that into the tax-free savings, because why pay tax on it? Why pay dividends, capital gains, whatever it is, if you have the tax-free savings account room, right? We try to shelter as much tax as we can through RSPs, TFSAs. If you're trying to save for a house, first-time home buyer, and only once we've tapped out those resources, do we start dealing with okay, let's invest in a non-registered taxable account, because we've maximized all our tax sheltering. As an individual corporation, David can talk about that. That's a different ball game. You want to keep money in the corporation, which David will chat about. But personally, if you're a sole proprietor, taking all the money yourself, that's where you would do it, right? You would max out your TFSA, make an RSP contribution. It's no right or wrong amount of how much to do. Everyone's situation's a little different. And then go from there, right? And then again, paying down debt depends on how much debt you have, depends on the interest rate on that debt. Because again, there's a bit of an arbitrage. If you're earning 10% on the market, but the debt's costing you 3%, well, now you're ahead. But if it's the other way around, debt's more than what you're earning, then maybe you want to pay down the debt, right? With the goal of a strategy of how many years until I retire, and how do I, not everyone goes into retirement debt free, but how do I get there as close as possible? Because when that income stream does dry up and you still have $1,000 a month debt payment for whatever it is, as an example, well, now that becomes a cash flow problem, right? So
That was super helpful. Thank you very much.
yeah.
Yeah.
So yeah, retirement, kind of 3 stages, right? Early retirement, that's kind of figuring out, the transition. That's where we see clients spending a lot of their money, right? They're spending a lot, they're traveling, it's all new. Mid-retirement, you're kind of in the groove of things. You kind of understand what retirement is. And then late retirement is all kind of like a reflection on life, right? And your legacy and so forth, which brings us to wills and powers of attorney. This is relevant for everyone. A will is the quality of life, or executing your wishes while you're gone. And if the power of attorney is while you're alive. There's 2 types of power of attorneys, one for financial, one for medical. And power of attorney in a will is some of the most important documents in your life. Because if something happens, you want to make sure that your estate, your wealth, and everything goes to the correct place. So I'll use myself as an example. I have a young family, like I said, wife, have a house, have a mortgage, have a kid, have another one on the way. If me and my wife were both to die in a car accident, as an example, what happens to our assets and who's going to take care of the kids? This is where thinking about a guardianship, a guardian. So you have an executor that's going to manage and distribute the estate, but a guardian is also, sometimes they're one and the same, not necessarily, but who's going to take care of the kids, right? Who's going to take care of the finances? Who's going to manage it? And, talking to an accountant like Dave, maybe that goes into a trust that gets distributed, some when they're 18, some when they're 20, some when they're 30, depending on the size of the estate. But every single person, whether you're 20 or whether you're 50 or 80, whatever it is, you should have a will and a power of attorney. Both in power of attorney for medical as well, because, God forbid if you're in a coma, as an example, who's the one making the decision to take you off life support or not? These are big decisions in life, and doesn't matter what level of wealth, what you do for a career, what stage in life you're in. A will and a power of attorney are, like I said, some of the most important documents, and these can get updated all the time, right? Where a will becomes also very important is second marriages, right? So a lot of people say, okay, I have 2 kids from one marriage A. I now married to spouse B. Oh, well, everything just goes to spouse B, but like my kids get half the estate. Well, depending on how that's written, if everything goes to the spouse, it could actually bypass your kids from your first relationship if the spouse did that. Unless you have a will that specifically states where funds go, the executor has to follow that will, or they can basically be sued, right? So if that's why a will is so important, because I've seen time and time again where family dynamics, you think everything's good and, you know, proper with your siblings and whatever it is, but money makes people do very strange things, which I've seen time and time again. And a will protects that from happening, right? Your executor, your guardianship, they should have a copy of the will, the power of attorneys. Everyone should know where these documents are. Keep them in a fire lock safe in your house, something like that, secure. But I can't reiterate enough how important a will and power of attorney is, because sure, we all know we're going to die at some point. We hope it's a long, long life when we're super old, but this can happen to anyone at any time. And that's why these documents are very, very, very important. Again, for anything, right?
Yeah, and I'll just jump in here really quickly, because as psychotherapists, we have the personal side in terms of having a power of attorney and an executor named in a will. We also have a responsibility to have that professionally, a professional POA and executor who will deal with our practice and our clients' needs. And I'm going to give a little plug, but at the end of this series, we had originally had 5, and we've just found a lawyer who does wills and estates and is going to talk with us. This has been an incredible beginning in that conversation, but to talk more about and the interplay between a professional and a personal will and POA. So I think you're right. I think we often want to avoid the discomfort that comes with thinking about being incapacitated or dying. And we don't want to burden people, but in fact that, you know, as therapists, we will have seen many of our clients burdened by people not taking care of their wills and estate. You know, we've had to pick up some of those pieces emotionally with clients, and I'm sure financially, Kyle, you and David, you know, see this all the time. But that doesn't make us as therapists any better at making sure we have it in place.
Yeah.
You know, we see that impact, and yet, you know, in our own fragility and our own discomfort, there's lots of us who really actually don't have these in place yet. So I'm gonna jump in on the bandwagon with you to say, like, hey, let's think about this really consciously, you know, purposefully.
Yeah. And with wills and estates and so forth, which again will be a different topic, more in depth, but there's a lot of going back into financial planning. Everything we do has a tax lens, a planning lens, and so forth, because registered assets like an RSP, a TFSA, so forth, you can put a beneficiary on that account. So let's say I put my spouse as a beneficiary to my RSP. Well, my RSP flows to her directly. My TFSA flows to her directly outside of the estate. So it flows outside of the will, even when it comes to registered. The will takes place, it governs more things outside of RSPs and TFSAs, like a house or a taxable non-registered account, as an example. And if you don't have a spouse that just kind of inherits that asset, there's no tax consequence for a spouse to do that. But let's say you both died, right? Let's say, going back to the example, me and my wife both die in a car accident. Well, our RSPs and TFSAs, you can have multiple beneficiaries. You can have a first line of beneficiary, which would be my spouse. And then you can have a second line of beneficiary called a contingent beneficiary, which they inherit if the first beneficiary dies before, right? So you can have multiple layers of beneficiaries, and that all prevents it from going to the estate. Because once it goes to the estate, let's say the executor sells the house, or there's a big taxable or any sort of assets outside of an RSP and a TFSA, that becomes the estate, and that is subject to probate. And probate in Ontario is 1.5%. So when we're planning for our clients, everything is how do we avoid as much probate tax as possible? And probate causes a lot of problems. Back in the pandemic, it was taken over a year to get probate. Now it's a little quicker. It's not as long as that. But if we can avoid probate or make the estate, even though on paper the amount is the same, but if from the government's eye, if we can plan accordingly to make the estate as small as possible, then we're saving probate tax. And there's a lot of different strategies around that. But that's where we come in as advisors and planners to say, okay, who's your beneficiaries? What's the second beneficiaries? What happens with all of this? And that's, again, where a will and so forth comes in. So good. One more slide. I'll just end it with this. I touched on, should I pay down debt? Should I save? Kind of mentioned that. Get this asked a lot. How do I buy a house in today's economy and home prices? If anyone figures that question out, please let me know. It's wild. And like I said, back in the day, home prices were affordable, even on one income. Now, two well-paying incomes still seems somewhat unattainable, especially as your first house, right? If you bought a condo, you leapfrog from a condo to a townhouse, you leap from a townhouse to a detached, whatever the case, and you've done that, then that's why the home prices are still high, right? But people just starting out trying to buy a house, it's very hard unless you get some financial support. And yeah, there's strategies around that. Like you can get a loan from a family member and then after 5 years refinance your house to pay them back, as an example. But if you're just trying to save, it's very hard. But getting your foot in the real estate market is always a good thing if you're able to, because real estate is an inflation hedge, right? So whatever the market's doing, whatever the case may be, real estate in theory is an inflation hedge. So if inflation's up 2%, your house price should go up 2%, right? It follows inflation, it follows the economy. That's why we call it an inflation hedge. So having money in the real estate market, if able, is always a good thing. But again, as we go into retirement, you can't, if all your income in retirement is CPP and OAS and you have $1 million mortgage, well, that becomes unsustainable, right? When you don't have the cash flow. What type of investment accounts? Kind of mentioned RSPs, TFSAs, that new first-time home buyer, non-registered taxable. David will touch on some new rules about joint accounts. And, if you have a corporation, keeping money in the corporation. So I'll let him talk on that. And what type of investments are there? So many people know stocks, bonds, mutual funds, GICs, so forth. That's, you hear these terms all the time. But the markets now are so sophisticated that people don't even know the options out there with index funds, private equity, alternative, structured products, you name it. Like there's a whole dictionary of investment terms of things you can invest in. And that's why dealing with an advisor to kind of navigate through that is more important than ever, because there's so many products out there that you can get yourself into a lot of trouble not understanding. And if something's too good to be true, it usually is. Like guaranteed 10%, no risk of losing money, walk away, because that's impossible, right? But yeah, and then I'll leave it. Biggest transitions: birth, death, divorce. We've all heard that before. And again, through all of these are some of the most stressful. And every time there's a transition, there's always money and movement, whether it's inheritance. How do I, pay for this new child? How do I now live on an income with, now that we're divorced? All of these stressor points is where an advisor can really come in and assist, right? So with that, I'll leave it at that.
Thanks, Kyle. That was very good. And I'll always enjoy listening to Kyle, and I'm always learning something from him, which is great. And what I'd like to do is build upon some of the topics that Kyle went over. And I'm going to share my screen here with you right now. But so just a little bit about me. My name is David Reine. I am a chartered professional accountant. I work with a lot of healthcare practitioners, or especially ones that incorporate and have professional corporations. And that might be something that you're looking at or not, but there are a lot of similarities of self-employed in that as well. And Kyle touched a lot on on how do you manage and deal with stress, and really financial stress. And financial stress, there's many different periods in life and different causes of financial stress as you move along in your life. But one of the biggest stresses dealing with finance is, and Kyle went over this a lot, is debt, and how do you deal with that and how do you manage it. And so I want to discuss a few things that kind of can help with that. And first of all, can you see my screen just to make sure I'm sharing?
No, we don't see your screen right now.
So let me try that again. How about that work?
Yeah, we've got it
Okay,
now. That's
perfect.
great. Thank you.
Okay. So what I want to kind of go over, and one of the areas of the stress is in helping you manage debt. And if you think about it, really, anyone who has a credit card has some debt, right? And so one of the ways to manage debt, if you have a house, you have a mortgage, you likely have a mortgage, you're going to have debt. And one of the stresses of finance is not knowing. It's not knowing, how am I going to make those payments that I need. And so one of the areas I'm going to go over is the need for a budget. And in addition to that, the need for a budget, but also looking at what is your net assets, and coming up with looking at like what your value of your net assets are at a point in time. And I'm going to look at how you can reduce some of this financial stress, but also looking at, from a tax point of view, what are important things to think about from a CRA perspective on making sure you're, one, minimizing taxes, and staying kind of ahead of the game and not falling behind, because that can add more stress as well. So a very important piece is really coming up with a budget and a cash flow projection. So if you're self-employed, and again, the income is a bit more uncertain than if you earn if you're employed and okay, my salary is X and I'm making X amount each month. It's a bit harder to do, but it's so important to do this. Now, I've been practicing accounting for about 15 years, but prior to that, I was a chiropractor. So I understand a bit about the healthcare profession and being self-employed and what that looks like, and just having to, probably my favorite course that I took when I was a chiropractor was in business planning and coming up with a plan of, okay, here, I'm going to open a practice, and this is my budget. I think I'm going to see X amount of patients, and I'm going to have Y of amount of expenses. And okay, well, this is what I need to do to break even. Okay, well, what do I need to do to make 15,000 a month? And looking at different plans, and it's important to do this as whether you're self-employed or incorporated for a business standpoint, but it's also important to do it from a personal standpoint. What are Kyle talked about, there's different stages in life. So what are life expenses, such as, there might be a wedding that you have to pay for, your kid's tuition for university, or maybe you're going back to school and you have tuition that you have to pay for. You're trying to save to purchase a house. Now, again, there's different accounts that can help you with that, such as a home buyer savings account, and that. But if you don't plan ahead, it's going to be hard to get there, and it's going to be hard to know what you can and can't afford. And so it's really important to do that. Another piece is, as part of the planning, is estimating tax expense. So as an employee, it's very simple. You get a paycheck from your employer takes off any taxes that are owing, and they remit it to the CRA directly. As a self-employed or incorporated business, you now have to wait until a full year, and then come April 30th, you calculate what your income is, and now you owe taxes. You also may owe HST. Now, I know they're looking at changing whether or not HST is going to be taxed in the future for psychotherapists, but you may have these expenses that you didn't plan for. You knew they were there, but you didn't really think about or budget for. So fast forward a year of practicing, and now all of a sudden you now owe taxes and you now owe HST. Where's the money coming from? Because maybe you've already spent it and there's not enough in this. So it's so important to plan for that, so you can set that aside and you can know, okay, here's what I can afford. These are the things that I can do. And the other thing is, I talked about the CRA, again, is in tax. You have to have a strategy. If you don't know what the tax is going to be owing, you don't have a strategy on how you're going to pay it when it's due. It's so important. And the reason why I say, yeah, when interest rates were much lower and the CRA interest rate was lower, the late payment interest wasn't as big. Now interest that owing to the CRA is 10%. It's not deductible. It is a very expensive interest rate to be on. You don't want to be borrowing from the CRA. The other thing is, if you're late on tax filings and you owe money, it's not just a 10% interest, but then there's penalties on top of that. So it's really important to kind of stay ahead of that. Another piece of, as a business owner, whether you're self-employed or incorporated, is how do you minimize these taxes and the amounts that you have to pay to the CRA? So a lot of people talk about, oh, whatever, I can write that expense off. They're talking about deductible expenses. Deductible expenses are anything that is really, I guess, considered a legitimate business expense or something related to the business. And I'll give you an example. So if you're going out for dinner with another psychotherapist, you're probably talking something related to your business. That therefore does become a deductible expense. Now, again, for meals and entertainment, for tax purposes, you can only deduct 50%, but it's a deductible expense. Similarly, if you went to a ball game or you did something like that, even if you met your accountant and you discussed something about your business plan, whatever, that still becomes a deductible expense. So promotions, travel and car expenses. So there might be situations where you can deduct your car expenses, and there's certain benefits of whether you, do you deduct it, do you lease a car, do you own a car? I mean, there's different things to think about in that, and different benefits depending on the type of car, et cetera, and the amount of use. Rent and utilities, you can write that off. And some of you, maybe you work from home, so you can consider having you would have a home office, and you'd be able to deduct some of the home expenses. So it's important to think about those expenses. Your cell phone, office supplies, and there might be other expenses that I haven't covered here. It's really important to find all those expenses, because the more you can deduct, the less taxes you are going to owe. When deducting or thinking about your expenses and that, it's important to maintain proper records. It's important because CRA, if you're deducting an expense, CRA can come back and say, okay, well, I want to see your 10 highest invoices, or they randomly will audit different areas. So recently they've been looking at travel expenses. They've looked at professional fees. So they look at different things. And so it's important to keep and maintain records. It's much easier these days. You can have apps on your phone that can track and store all your documents for your invoices and stuff like that. The other area that's important is some people will get away with using an Excel spreadsheet to keep all their track of their revenue and expenses. But if the more expenses you have, the easier it is actually to do it when you have a product like QuickBooks or Xero or some other financial app that actually links to your bank account and can pull transactions that way. And these apps can also integrate with your booking system. So, depending on whether you have, if you're a sole proprietor or a single practice, you might not need some of these apps. But if you're have an office where you have associates working for you, and there's more involved, you probably would need something like some of these apps to maintain these records. It's important to maintain the records, but it's also important to understand what are your tax filing deadline requirements. The reason for that, like I said, interest is charged at 10% on overdue balances. There's also penalties if there's unpaid balances by the time you file, if you're late filing on any of these returns. So as a sole proprietor or self-employed, you have to, your first year, you're not going to owe tax until April 30th. But after that, the CRA will start sending you quarterly installment reminders. And the payments for those will be March, June, September, December 15th of each year. The HST filing is due June 15th, with quarterly installment payments as well. And your personal tax return as a self-employed would be due June 15th. But keep in mind that any taxes owing is actually due April 30th. So interest will start charging after April 30th if not paid. As a professional corporation, so if you incorporate, it's a separate entity. There are separate tax returns. The tax return is due 6 months after year end. So if it's a December 31st year end, it would be due June 30th. Any taxing above and beyond installments that are due is really due 3 months after the year end. Corporate tax installments generally should be paid monthly. There's certain circumstances where it might be paid quarterly. Payroll taxes, so a lot of times if you're incorporated, you would put yourself on payroll and that's how you would make money. And so you would need to make monthly remittances to the CRA, as well as file what's called a T4, as well as possibly T5 if you earn dividends as well. And those filing deadlines are February. HST return is due 3 months after the year end. So if year end was at December 31st, it would be due March 31st. Again, installments are required each quarter. Now, I talked about self-employed versus incorporation. There's a difference. There is a big difference. And incorporation, if you're incorporated, there are some tax benefits. There can be tax benefits from a tax point of view, and benefits, and you need to think about it, and it's not right for everyone. So I always get asked, should I incorporate? When's the right time to incorporate? Keep in mind, if you're incorporated, it's a separate entity. And like I mentioned, not only do you have your personal taxes, but it's separate tax filings, separate requirements. And so you do need to maintain those up to date, but it's an added cost of running a practice or running your business as a corporation. So you need to think about it, but there can be significant benefits. One of the benefits is from a liability perspective, it offers some protection because it in itself is its own entity, and your personal assets are kind of outside of that. So if something were to happen and someone sued the company, they can't come after you. They're coming after the company. Now, if you do something negligent, then they can come after you, but that's a different sort. But there does offer some protection. The main reason why, though, people incorporate as a professional is for the tax advantage. It's the ability to build up equity or build up funds in the corporation at lower tax rates, which then allows you to invest more and build more wealth and, be able to build more wealth, whether it's investing, et cetera. But and I'll show you here, the difference is the lower tax rates in a corporation. If you're self-employed and you're at the highest tax rate, the tax rate is 53.53%. So for every dollar, you're earning less than 50 cents for every dollar you earn once you're at the highest tax rate. If you're incorporated, the tax rate is 12.2% if you're if it's 500 for the first 500,000 of income. The tax deferral there is $62,000, almost $62,000. So that means if you earned 150,000, assuming if you were at the highest tax rate and you were able to leave that 150,000 in the corporation. So you took out money that you needed, that you earned throughout the year, but you were able, that you needed to live off it, and you were able to leave 150,000 in the corporation. You're saving an extra 62,000. So on 150,000, you would have $131,700 to invest versus $69,705. So obviously $131,700 has the ability to earn more money than investing $69,705. Now you can also, you could use the funds in the corporation to invest, and you can give it to your wealth advisor who can then invest it and build up more wealth. You could use it to invest in real estate. So open up a real estate corporation and loan the money tax-free and use it as a down payment for a real estate investment. But it's the benefit, the power of being able to have that extra money that you can invest. The other thing is, as you build up that wealth in the corporation, down the road, when you go to retire, it's part of that whole plan of, okay, well, when I retire, where am I getting my money from? Where, you're probably building up your RSPs, but you're also going to have this corporation that's going to build up equity that can then pay you as though it's a pension down the road at hopefully lower tax rates, as opposed to in your higher income earning years where you're taking it all out at a higher tax rate.
David, can I just pop in for 1 second on that piece? Because that question, should I incorporate or not, it comes up a lot among sole proprietors. I had said to me, if you can leave X amount of dollars in your corporation, if you can take enough to pay your living expenses and still leave money in the corporation, it's worth it. Now, what X amount of dollars that I got told, anywhere between 20, you have to be able to leave 20,000 in, or you have to be able to leave 50,000. It's not worth it until you can leave 50,000. And it was very confusing. Like, okay, well, that's a $30,000 differential.
Yes,
is a pretty big thing for like little old me, with my little private practice.
For sure. So it depends on how good your wealth advisor is.
Okay.
Because it depends on what you can earn on those investments, but generally speaking, I would say you want to be able to leave at least 50,000 and be able to build up on that every year. So, and listen, if you know that, okay, my first year I'm not going to be able to, but my second year I'll be able to start 30, 40, and then it'll get to 50 and 60. Like, the reason why, and the reason why they say it's commonly said you need to earn at least 50,000, at least to keep in the corporation and then build on that, is there's the added cost of running it, right? So there's accounting fees, the legal fees, even just to set up. So that's why it's the added cost, because the benefit is I now have this extra 50,000 and that I can now invest and grow. And the more money you have that builds up, like if you have $1 million that you've built up in there, it's compounding. You're earning way more than the cost of running the corporation. So that's why it really just depends. But the other benefit is you're able to time when you take the money out. So let's say, and I have some clients where they're like, I don't need money right now. I have some savings that I've built up, but I want to incorporate, and they incorporate, and I still actually have them take out salary, even though they don't need it personally, because I utilize their lower tax rates. And sometimes they say, well, I'm planning on buying a house, or I've bought a condo, but it doesn't close for 2 years. I'm going to need to come up with a big down payment in that time. I then say, okay, well, let's take out enough salary to maximize, use the lower tax rates in year one, same thing in year two, so that you can put it away. And then in year three, you might have to take it a bit more, but at least you're not taking it out all in 1 year where you're at the highest tax rate. So there is different tax planning that can go into that to help minimize taxes. But generally speaking, that you don't want to do it unless you're able to kind of start off with 50, but be able to build upon that.
Okay, and as an accountant, I mean, you're a chartered accountant, that those kind of decisions are the things you can help a client
For sure.
figure out, right? When you look at the specifics of their circumstance, you can be like, hey, this makes sense for you to move ahead on, or this is too early, or like, let's think about when you take it and when you leave it.
Yeah, and I mean, one of the questions that I'm always asking is, okay, what is your 5-year plan? Like, what is your plan? And again, these plans change all the time. So you might come up with a 5-year plan, and a year 1 or 2 years, when I speak to you next year, it might have changed a bit. It could have changed drastically, and things happen. But it's always important to have that plan in mind and revisit it, and then make changes, but make decisions based on that. But yeah, you're very right. It's so important to kind of you need to have that discussion. Like I'll speak to clients or prospective clients, say it's not worth it. So there's a lot of times where I just say, based on what your needs are, it doesn't make sense to incorporate. And it's something to worthwhile looking at maybe 3 years from now, but it's not something to be looking at right now. And again, there's different circumstances for everyone.
Yeah, it really points out that this is quite a nuanced discernment, actually, and having that kind of, the wealth management piece, the accounting piece in, somebody else's brain in with us in making those decisions can really maximize a positive outcome, right?
Yeah, for sure. And so again, I mean, those are, I list a bunch of key takeaways that I discussed, and keeping proper records, tax filing deadlines, knowing what a deductible expense is, and preparing monthly and cash flow budgets, preparing a net worth statement to say, like, it might be okay that you're in debt $1 million if your assets are 6 million and they're producing cash flow to maintain the debt. But you also want to look at, okay, sometimes you're sitting with a credit card debt that is paying interest at exorbitant rates, and you have a home equity line that you're not using that's at a much lower rate. You probably are going to pull from the home equity line to pay down the credit card, assuming that you're responsible enough not to build up that credit card debt again. You can't pay. But there are certain strategies that you'd want to think about and need to consider. But the biggest thing, to be honest, is really that planning piece. It's that budgeting and cash flow. Because from there, it's okay, I know what my financial needs are, for the next year, and what I expect it to be for the next 2 to 3 years. And here's what I expect to earn, and what is that differential. And sometimes that pushes you to say, okay, well, I need to work harder. I need to earn more. Or sometimes it's, okay, I'm very comfortable. I can do this. The biggest thing that I have clients that come to me and they haven't filed taxes in 4 years. They owe debt. They're not sure what it is. But once they do it, the amount of relief they feel after they just knowing and that it's the I knowing, okay, well, here's my plan. This is how I'm going to pay it off, and this is how I'm going to do it. It is such a huge life-changing moment for them. And it's so, and that's why it goes back to if you're preparing these budgets and that you're not going to get into those situations or less likely to get into those situations, and you'll feel much better for it. I do have to point out one last topic before I finish is I know Kyle mentioned the trust. So the CRA recently came out and said anyone who has a joint account where it's really not your funds. So you might have a situation where you have an elderly parent and you go onto their account to help manage the finances, or you have a minor who you're holding funds in trust for. CRA said, okay, if the funds are above 50,000, you now have to file a trust return. This trust return technically would have been due April 2nd, although they wouldn't give penalties on it. Today, they actually recently just came out and said they will not, you don't need to file these anymore, which should give some people some relief, because I know a lot of people were stressing about this, because this was impacting everyone. This isn't just impacting high net worth individuals, it's the everyday person. And so that is some relief and good news on that front.
That's awesome. Thank you, David. There's
Sorry,
okay.
I just want to touch on one thing about the debt. A lot of people don't know this. Again, I'm not a lender, but from a planning perspective, you can go to your bank and consolidate debt into a personal loan. So if you have all this credit card debt or student debt or whatever the case may be, if you have a line of credit or a home equity line of credit, that's your cheapest option. Just pay that down, like David said. But a lot of times we see clients that, with credit card debt at 20% and so forth, banks can wipe that out and consolidate everything into kind of what's called a demand loan, a personal loan. So the rate will be lower than what credit cards are. So if you find yourself in that situation of mostly multiple credit card debt and so forth, there is options that your bank can help with to consolidate all that into like a specific type of loan that has a term, almost not like a mortgage, but has more of a term to pay off in like 5 years or 10 years, whatever it is. And that could simplify things. There's consequences to doing that because you basically then lose your credit cards and so forth. But there is options if you're really, really struggling on the debt side.
That's really helpful. Thank you, Kyle. And I know that there are also like RSP loan availability. There's I know a number of things we haven't really had time to touch on tonight, but I am aware of where we're at in our evening. There's a couple questions that came in just now. How much does it cost to have a wealth planner or a financial planner or an accountant, right? How do you guys get paid? And I think the answer is different for both of you.
Yeah.
And when do you recommend somebody starts working with a wealth manager or an accountant?
Yeah, so maybe I'll start on my side is a lot of people think it's more expensive to deal with a wealth advisor. Depends on how they manage money and depends on your level of wealth. So how I kind of say it is it's actually a lot cheaper to deal with someone like me if there's enough wealth, and I'll kind of explain why. So let's say you have $10,000, right? You can do it yourself. You can go to, a self-serve online free trade, $10 a trade, whatever it is, buy a portfolio, but that's you doing it yourself. But let's say you have $10,000. You walk into your bank branch, you sit down with someone, they sell you some sort of BMO mutual fund or TD mutual fund or whatever the case may be. That's all they can sell you. That's all your options if you don't want to do it yourself. Those mutual funds have very high fees, 2.5%. You don't see them. They're built inside the fund. Once you start building wealth, and this isn't per account, this is like total wealth of like you, your spouse, your RSPs, TFSA, so forth. Once you kind of build to about 150 in assets, you might deal with the dedicated financial planner at your local bank branch. That planner can only still sell you their own bank mutual funds. So even though you're getting a higher level of plan in, you're still paying the 2.5%. Once you kind of get to 200,000 and above, then you get introduced to private wealth, someone more like me. And you don't need 200,000 to deal with me. This is just to answer the question. We deal with anyone. We find solutions for anyone. It's not a matter of wealth. It's more about fit and so forth, which we didn't talk on. But to answer the question, once you get to kind of 200 and up, you can deal with a wealth advisor. Every single wealth advisor out there or investment advisor, there's multiple different titles. Everyone runs money because now you have the whole investment universe now available to you. Unlike just being sold BMO mutual funds, I can buy any security anywhere in the world on any market. So what I do, but the advisor that sits beside me still might be selling mutual funds. Everyone manages because we manage our own book. Like BMO's not saying this is what you have to manage, this is what you have to sell. We create completely custom portfolios. Every advisor manages money differently, unlike filling out a questionnaire saying you're a balanced portfolio balanced client, here's your mutual fund. We don't do that. So then we don't invest in mutual funds, we invest in individual stocks and index funds, which significantly lower your fee. Most 99% of advisors out there will charge an asset under management fee, which is usually tiered. The more money you have, the less percentage you pay, and that percent will be somewhere between 1 to 1.5%. Now, when you compare that to a mutual fund at 2.5, you could be cutting your fee in half by dealing with an advisor while also getting customized solutions and planning and all the services that are there. So a lot of people think it's more expensive, but it's actually, depending on what advisor you deal with and how they manage money, could be quite a bit significantly different. Since we charge an asset under management fee in a non-registered account, you get to write that off on taxes. So then it becomes even less to you. You can't write it off on RSPs and so forth. But since we're charging an asset under management fee, there's no commission, right? So if I'm buying BMO and selling TD or whatever, there's no cost to trade because we're charging an asset under management fee, is how we get paid.
And from kind of an accounting standpoint, generally speaking, if you're incorporated, self-employed, you probably should have an accountant that can help you navigate the tax filings, tax deadlines, making sure you're minimizing your taxes from a deductible standpoint. If you're incorporated, you for sure need an accountant. The way I practice and the way most accountants practice is usually it's on a set fee basis. So if it's self-employed, here's the fee to prepare the year-end or your tax return and HST return. If you're incorporated, here's the fee to prepare your year-end, including T4, T5s, HST. And the only other piece is whether the bookkeeping, who does the bookkeeping and the costs associated with that. But it's usually done based on a set fee basis. So when to speak to your accountant, generally speaking, when you start practicing, you really should have an accountant that you're working with to be able to manage that.
I would really jump on board with that, David, too. I know, like, I've been in this business for over 35 years, and in my very early days, where I literally had like one column money spent, one column money made, and I hand wrote my invoices, right? Oh man, it was a rinky dink thing. But it worked. It was fine. And I went to a local gal who did, my personal taxes. But then as my practice grew, as things became more complicated, I really needed somebody to give me some advice about how to manage that. And then, of course, now I'm incorporated with Redbird, and that's a whole different kettle of fish where, to be honest, having a good bookkeeper, a good accountant, and a corporate accountant who knows, who can file those taxes and help you consider, like, the bigger you become in your practice, whatever shape it takes, really the more essential both of you are to
For sure.
managing these circumstances. Yeah. There was a question here, and I don't know, Kyle, if you can speak to it or not. I don't know if it's your lane,
Sure.
but somebody's asking about BMO business accounts or differentials around. This is a real banking question versus wealth management. But
Yeah. So not my area of expertise, but I can answer it. So yes, every bank in BMO specifically depends on the level of sophistication and basically revenue that your business generates. For most psychotherapists, especially if you're incorporated or have a business account, would likely deal with what's called a small business banker at a local bank branch. Once you get more sophisticated, then you go to commercial banking. And then there's different levels of commercial banking based on level of like wealth and revenue and employees. But every bank, there'll be a small business banker, and they usually deal with companies with revenues under 500,000, and they'll do like business bank accounts and like help with cash flow and so forth. So there is people available at the bank branch. And again, if you're, and it's more about borrowing too, if you're borrowing, and there's different levels. So yeah, we definitely have those services. It just depends on revenue and if there's a borrowing need, how much that borrowing is. Or if it's a cash flow management thing, there's people available for that. But they're called small business bankers specifically for that focus.
And I'll just add into that, Leanne Woods, who did our first and third workshop in this series, in the third workshop, she did speak to doing kind of really do your research on comparing business bank accounts, because some come with some pretty hefty fees that might be really unnecessary, and there are opportunities to find a low service fee for small business that still gives you enough latitude with your banking requirements, right? So she was saying to us, like, do your due diligence, really do a compare. What are you getting and how much are you paying? Because at the end of the year, those bank fees start to be a bit surprising.
Yeah.
You're like, whoa, that was a bit
Yeah,
of money
and
I didn't know I was spending.
yeah, in all banks, it's a marketing thing, right? So like TD, RBC, BMO, we all say, oh, we have this special plan for healthcare professionals or doctors and so forth. It's all the same. Every bank offers different things, but it's all the same basically product. It's just the way it's marketed. So if you think that TD is tailored more to health professionals than BMO is, it's not the case. It's all just marketing. You're getting the same exact bank account. You're just getting, it's just marketed different, right? So
That's good.
but we do have different specific programs for doctors and different healthcare professionals. I'm not 100% sure if psychotherapists fall into that category, but someone at the bank branch would know.
That's great. I'm really aware of time. I want to thank the participants for being here and on a long weekend evening. And I really want to thank both you, Kyle and David. Um, it was lovely to see you balance the kind of, awareness about the emotional piece that's related to money, both as business owners and also as therapists, where we're working with our clients and we see them going through these life transitions, and how we can be sensitive, not just on an emotional level with them, but like have a bit of knowledge. It matters for us as therapists to be able to talk about some of this. We're not advisors, but the more we know, the easier it is for us to do our work. So I want to thank you for that. And I want to thank you for the real practical pieces that give us a really excellent starting point, to think about, how do I run my business? What's best for me? What are the considerations in my current circumstances? So really, again, a big thank you, Kyle and David. It was great being here with you tonight.
Absolutely.
Thanks for having us. Really appreciate it.
Okay.
Sure.
We'll say goodnight for now, and folks, keep an eye for future Redbird therapy workshops. The 5th one is coming up in April if you're thinking about group practice. And then there's going to be a 6th one, which will be with a wills and estate lawyer, so we can dive a little bit deeper after opening it tonight. Have a great night.
That was great.
Thanks, everyone.